pleasure to be here among you today. So as Gavin mentioned, I'm a CPA. I work in an accounting firm that was founded by my father, specialized in the film industry. We've been doing this for 35 years. So typically we accompany producers from really the beginning stages where they have a preliminary budget, preliminary financing structure. We help them solidify that financing structure, help with the cash flow. Not necessarily do the bookkeeping, but we can guide you through the tax returns, deal with audits, all the certification when it comes to applying for advanced rulings or capital certificates. We operate across Canada. We specialize in interprovincial co-productions and as well as international co-productions. We work on over 100 productions a year. Today I wanted to talk about the four practical structures that you see within the film industry. So the first one is operating as an individual. That's usually the first step. You get contracts on your own. You might even produce a film on your own. And the next step would be incorporating, having what we call a loan-out corporation, where you render your services through that corporation. Next step would be to have a parent company where you develop projects. The intent of that company is really to develop IP and get projects going. Once you get them, the last structure is the SPV, which is the single purpose vehicle, which is entirely dedicated to film production. Whenever your project is done, you can either recycle that SPV or dissolve it and move back the rights to the parent company, which with time will accumulate your filmography and collect on the royalties and licensing and any other revenues relating to the film. So a little bit more about myself. So as I said, I'm an accountant. I've been working with my father for all my life. I didn't go to summer camp. I was penny cash auditing productions when I was young. I then went to university and I did 4 years at Raymond Chabot, where that was basically my accounting school. And then I came back, and it's been 10 years that I've been working with my father. I also teach at McGill, financing and business models in creative industries. So we talk about financing not only in film, but music, events, any other creative industries, books. And I also do conferences like today, in film festivals, that sort of thing. So here's, like I mentioned earlier, this is the the peak activity organizational structure that you'll see whenever you're established. So you have yourself as an individual, that owns 100% of the parent company, and then underneath the parent company, you'll have your different projects that are going on. That you'll source the financing through the parent company usually, and then you'll transfer it to your SPV. And the reason why we want a separate SPV is that in order to trigger the tax credits you need your SPVs, you need your corporation, your film entity to be entirely dedicated to the producing of the film. The rule is that you're principally engaged in film production. That means 51%. But recently I've seen a disastrous case where the government says, okay, we're going to look at your revenues, and based on your revenues, you're not really doing film production, you're doing marketing. Because it happens that to generate revenues, most of the companies, they do ads, they do marketing, and they try to keep, administratively, it's easier to keep one corporation and stay in one corporation, deal with one tax return, but for tax credit purposes, now I recommend that there's a separate entity that handles all the film production. So all of the funding that's being sourced is transferred, all of the costs are incurred in the SPV, all contracts are with the SPV and the vendors, the employees, the individuals that are going to work on the film. It also isolates the risk if you get a private investor. It also isolates the risk if you're making sales in other countries. As you know, there's withholding taxes whenever you sell to a different territory, like the United States. Recently, there's one of the SPVs, they got a notice from the IRS saying they owe $5 million because they didn't declare some sort of income that it was all wrong. Like, we sorted it out, but it's still scary, and to me, like, the SPV must be separate, so it doesn't affect all the IP that you own in the parent company. I'm going to talk afterwards how you dissolve it, because you want to keep your things clean. You don't want to have 10 companies underneath the private company. I'll get there. Talked about the private investor, and then so that's what I'm going to get to once your projects are finished. This is the final type of structure that you have.
And I'll add that SPV, sometimes you'll hear be referred to as an SPPC as well, which is a single purpose production company. I heard that at NSI, so maybe it's a more
Right.
national term, but anyway, it's
Right.
the same thing.
Yeah, I don't want to confuse you.
Yeah.
It's really your production entity.
Can SPVs be in a different province from your operations, like your parent company?
Yeah,
Yes.
it's a very good question. You can have it in a different province. You can also have it in one province and register extra-provincially in another province. Let's say you want to claim tax credits in a different province. So what happens is, I always encourage producers to keep their own IP, okay? But sometimes some of the work, some of the people come from other provinces, they'll be rendering services in Ontario, for example. So they say, okay, I'm gonna get a co-producer. So a co-producer is gonna earn a portion of your IP, you're gonna share a portion of their IP for really nothing. Like they're just gonna hire the people that you found, and okay, the payments are gonna go through them. There might be some administration done, but you could just register that same corporation in a different province, and you'll need a permanent establishment. I know we have a sister office in Ontario. We have people in Alberta, in BC, so we just set it up with them, and so that you can claim tax credit in different provinces, keep your own IP. First step is the whenever you're an individual, I usually get questions like when is a good time to incorporate? Is it fiscally better to incorporate now, or should I continue doing all my invoicing as an individual? 105,000 is the threshold where you'll in Quebec, where the combined tax rate will give you 27%. And whenever you're incorporated, whether you make it $1 or $1 million, you're always taxed at 26.5%. So create a corporation means you have to do another tax return. There's more bookkeeping, not more bookkeeping because you're ultimately doing the same operations, but you have just another entity to manage and another tax return. You'll get a lot of more mail from the government, as I'm sure you've had experienced. It's just gonna drive you crazy. And nothing stops you from producing a film as an individual. You can still capitalize your costs, defer your revenues until you exploit your production. So unless you want to get tax credits, unless there's some grants that you want to access through a corporation, then I understand. But otherwise, like at the beginning, it's good. You could just operate on your own. I mentioned here that the 26.5%, that means without the small business deduction. It might be something that you've heard of. Whenever you have 5 employees in Quebec, you're entitled to the small business deduction, which decreases the tax rate to 13%, which is great, but you still need five employees, and within the film industry, it's very rare. You hire people when you have a project, and then you move on. As an individual, if ever you earn more than $30,000 after 4 trimesters, you're obligated to register to GST QST. If you earn $30,000 one of the trimesters, you must register. And please, if this is all stuff that you know, let me know. I can press fast forward on something else. There's a notion that, I don't know if you're aware of the quick method of claiming your GST QST. So whenever you're registered to GST QST in Quebec, whenever you invoice for your services, you have to invoice 14.975%. 5% for GST, 9.975 for Quebec. If you are an individual rendering services, not fiscal planning, not bookkeeping, you're not a public entity, so anyone like a producer or anything that's not relating to finance consulting is eligible to the quick method, so whenever you're invoicing, you're charging 14.975% of taxes. You have to remit that 14.975% to the government. However, if you apply to remit through the quick method, you get decreased. You decrease the taxes that you have to remit, meaning you are getting the 14.975%, but you only remit around 10%. So you're pocketing 5% more, which might be worth it.
And when can you do that? When can you remit? Like, is there a
Quarterly?
It depends. You can decide. It depends if you want to keep your things, like on a monthly basis, you can do monthly, you can remit monthly, trimester, and annual.
Okay.
It's also, that's also a tool to manage your cash flow, you know, because you're collecting your taxes and that you're deferring your payment to the taxes.
Yeah.
And it's very important to pay your taxes. GST/QST is one of the most important things to pay back because the government can go after your personal assets.
Yeah.
Whether you're incorporated or not, they can go to you and collect.
Okay.
Why is the quick method good? Is if you're rendering services and you don't have any expenses, you don't have to claim any GST/QST on the expenses that you're paying. Like let's say you're just rendering your services, then it may be a good idea just to take the smaller rate and pocketing the 5% extra. You can access the quick method as well in an incorporation as a loan note. Home office, is it something you want to hear about?
Yes.
Yeah. Okay, so if you're doing all your services from home, even if you're a producer, you're doing all of your work from home, I usually allocate 15% of your home expenses. Home expenses could be your rent, your utilities, internet, phone. You could put 100% or close to 100% if it's close to the truth. If it's reasonable that you use your phone for business only. If you have a mortgage, the interest is deductible, so 15% of your mortgage, your taxes, school, municipal taxes. So these are all expenses that you could deduct, and you could go over. So the rule says you use the global square footage of your personal residence, and you allocate a portion that's dedicated to your work. So you could do the calculation. I use 15% as a rule of thumb. I never get bothered by it though. The other tip I would like to talk about is also how if you're doing operating on your own as an individual, have a separate bank account only for your business income.
Mm-hmm.
Okay, and that's like a cleaner way to handle your bookkeeping and try to manage all your business together instead of parsing out either at the end of the year or the end of your reporting period, sorting out what's personal, what's not. Just have a separate bank account and try to keep a recording and the backup of what happens every month properly classified. It also helps with the audits if ever you get audited. But whenever someone goes and has to work in the US, what happens is whenever you earn revenues in a different country, usually the country will want to tax you. It's the responsibility of the person that's paying you in that other country to withhold some of the tax. Like we have here, deduction at source, the same principle there. But because we have a tax treaty with the US, you can claim through the W-8 BEN. So under the paragraph business profits, that you can claim that the treaty-based exemption that we call, which means that you'll only pay tax in Canada. So you won't get any withholding, you'll be paid your full amount in the US. Second thing is whenever you're invoicing to a US company or a foreign company, you don't need to charge GST/QST, especially if you're rendering your services outside Canada. Even if, let's say you're invoicing a Canadian company and you're rendering your services outside Canada, you put on your invoice, my services were rendered outside Canada, you don't need to charge GST/QST.
If you're charging somebody in another province, do we have to put GST/QST or just GST?
Yeah, I put, the rule is GST, I looked it up. Okay, but I always put the 13% because I'm scared of the government. Honestly.
Yeah.
And that's our practice, and we get questions from clients like, why don't you charge 5%? I don't care, like you're gonna be able to claim it back once you pay it. I'm gonna do the same. I don't want to be bothered. But the rule is 5%.
Yeah, because some of the Ontario people, like I did put GST/QST, and they only paid me the GST. Like
That's it. So you could charge the 5%, the 5%, but I charge the 13%.
The HST.
The HST.
Yeah.
Okay.
Can I just ask you a quick question on the BEN-E? This comes up in every group I'm in. Of all the things you can check off, what kind of corporation are you supposed to check off?
Active. It's active. I have a few slides somewhere. I can go through it with you, or you reach me afterwards. I'll just send you the screenshots because I teach it too. But you say active. It's an active business. And I think it's number 37, but you have to mention the paragraph number. So there's a distinction. So whenever you render your services in the US as a corporation, this is business profits. It's the article that you have. In order to claim the treaty-based exemption, you have to refer to the business profits, so Article 7 of the treaty. And then they'll say, okay, it's fine. If you're an individual, it's independent personal services. And then if, like in the case of Gavin, that you're licensing, you're what they call in the treaty is royalties. Automatically, they're supposed to withhold 30%. But because of the treaty, you can lower it to 10% by filing a WIBN, and you're referring to the paragraph called royalties. Does that answer your question? Yeah. I know it's
My royalties though, mine was funding.
It's a funding.
That was a film fund.
I'll be
Right,
honest,
I remember.
I usually just put the address and just write Canadian Corp and leave it blank, and it's never come back from the accounting, but
You're
they have
right.
all these weird.
And they pay you 100%?
Oh, yeah.
Okay, good.
Like with all, over 10 years with like tons of US companies, it's never been an issue, but I was just curious what the proper one is. There, I can't remember the names, but there's so many esoteric, there's like, names, like there's nothing that corresponds to Canadian Corp. It's like, I can email you. I don't want to waste everyone's time with it, but it's
Yeah,
like,
okay.
And this is where,
Or
like,
if we have time after I
the reason we're here today is to say also, you don't have to learn all of this today. The reality is when you're gonna need it, Michelle's there to help.
And you have, I'll hopefully share most of the notions so that you know where to look. If it's an acquisition in the United States, there's no withholding tax, and you can lower it. So it's really you're purchasing your film for the lifelong rights. There's no withholding.
I'm a US citizen, so do I get to take advantage of this since my business is incorporated here, or?
You're a U.S. citizen, so
Dual?
you have to declare your taxes every year in the U.S. Right?
Yeah.
And so I've been through this with I think a friend of yours again. Are you Ed?
Yes.
Ed, you want to
Just about to ask the question.
You want to take this over?
I don't really have a good answer yet because I haven't been in the situation where I had to but what I did this year was that there was a special statement in your Schedule 1 that you can file, but you have to have an accountant do it. That basically there's like a special statement of Canada tax exemption, something like that.
Because you want to avoid double taxation. So
Yeah.
my answer is, what is your tax rate in the U.S.? If your tax rate is lower in the U.S. than in Canada, declare your taxes in the U.S. And because we have a treaty which avoids double taxation, you only be taxed once. So in your U.S. tax return, you'll declare that revenue, you'll pay tax in the U.S. Let's say the taxes are lower than Canada. And then in Canada, you'll declare that revenue, but you'll say, because of the treaty, I'm exempt from that revenue, and this is the tax I already paid. I'm not supposed to pay extra tax on that amount because it was paid as per the treaty.
Yeah,
So
it's
that's
just
what
that
we
you
looked
have
at.
to-
I think we couldn't answer what the tax rate was.
Yeah, I ended up figuring that out with someone else, and I had a firm do this, and it's just that it has to be done manually. You won't be able to do this through like TurboTax or whatever. You need somebody to do it for you. This applied in my case to self-employment tax in the US because it doesn't automatically get deleted, but with that statement it does. In regards to funding and things like this, I'm not sure what it'll be filed under, like is it self-employed or if you're incorporated, it might be a little different, but probably it's the same scheme, but it's worth double checking.
Yeah, that's it. Because it's a gray zone, because the treaty says that you pay taxes in the country where you declare your revenues. But in your case, because the US, they request, like it's mandatory for you, either though you're not a resident, you're a citizen, so you have to declare your revenues, you have to do it. So I would say just find out which country taxes less, based on your bracket in Canada and how it works in the US, and declare it in the country.
Okay.
And then you declare in both countries, but you pay tax in the one that's less tax.
You definitely, Canada, especially in Quebec, you're very likely to be paying more tax overall than the US, and it is required, like you should be paying here first in any case, so that's the way to go, I think, regardless. Yeah.
Okay, thanks.
Pleasure to meet you in person.
And the other thing to take away as a reminder here is, because it's come up a lot, that, you know, it's reasonable for us to expect the government agents who are asking us these questions to know. The reality is they don't. So we have to learn, and then we teach them how the law works or how the accounting works, and then they say, oh yeah, that makes sense.
Can I just ask you?
Yes, of
I
course.
found the W8 penny on my phone, and it's the stuff like non-reporting IGA, FFI, foreign, blah blah blah. You know, meets the non-erosion, blah 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 test. Like
Yeah.
there's hundreds of checked boxes like that.
Yeah.
Can you just ignore all that stuff?
No.
Okay.
No, but I understand your point. Like, I've sent 100 of them, and it's like maybe 30% come back if there's something wrong. Like, even if you make an error, sometimes they don't come back and it still pays. I don't know if they really look at them.
And is there a simple answer of which one?
Yeah,
should all
there's
be
a simple
checking?
answer for Canadian corporations.
Which one is it? Can you say or?
Yeah, show me if you want. It's here. Company with an item of income that meets active trade or business test. And then here, special rates. This is where you put the paragraph, the percentage of claim. So if you're doing, let's say, a license, you want to bring it down to 10%, and you explain why. So here I just copy paste what's in the treaty.
What would you like? A whole day of accounting?
Oh, yeah.
It's
I'm gonna
just
have to step up. I just
delightful.
wanna win. In my company, I have a situation where one of my steadiest source of income is ad revenues from YouTube and various web platforms, for
Yeah.
which I filed a WE,
Yeah.
that form there, so there's no withholding or anything. A lot of the times I was fortunate enough to also do contracts where I could charge taxes, but like I'm in a situation now where my fiscal year end's gonna end, I did not do any contracts. I only had this passive revenue that I did not charge taxes for, but I still like claim taxes on my, you know, operating expenses.
Right.
Is that gonna be problem?
No,
Like I'm
no,
just
it's
wondering,
fine.
like,
You're an
is
active
it-
business.
Yeah.
You're still
Okay.
working.
Like, oh yeah, okay,
As long
so
as you're still
even
working.
though I don't, cause it's always that thing where like you file it, like, you know, whenever you fill out
And you
the
put
form.
zero revenues?
Yeah, zero, or, yeah, exactly,
Yeah.
and it's always like, oh, it's weird, cause like technically there is some revenue, it's just like, you know.
Not now.
Yeah, exactly, okay.
No, I wouldn't be concerned.
Okay,
As
perfect.
long as you're active, you
Yeah.
know, that you try to solicit contracts.
Yeah,
for
exactly.
business. Okay, second structure is the loan out corporation. I'm sure it's a term that you all know. So typically a loan out corporation, you only render your services in that corporation. You don't really do development, but I understand that if you want to keep things simple, you know, you do it. Let's say if someone claims, it hires you in a production and they claim tax credit on it, they want to know that's the only thing that you're doing in that corporation. It's not really your concern, but if you call yourself a loan out corporation, it's supposed to just be a vehicle where you render your own services. Whenever you're incorporate, you're going to be asked, do you want a federal charter? Do you want a Quebec charter? If you're going with a Canadian charter, then at least you need at least 25% of your directors to be Canadian residents. Quebec, there's no requirement. That comes in handy, not necessarily for loan out corporations, but it can be handy if you're a citizen of another country or a resident of another country and you want to produce here, for example, you want to claim production services tax credits, then definitely you're going with a Quebec charter.
That would depend on your situation then.
Yeah. But if you're gonna operate in Quebec,
Yeah.
you can just go with a Quebec charter, and it doesn't stop you from registering extra-provincially down the road. Your name is protected here in Quebec instead of federal.
Okay. Wait, so if we're gonna do production services Quebec, and we go with it, like, if we're, we're working with, I don't know, Colombia, for example, and you go with a Quebec charter, what's the advantage of that? for example?
There's no requirement of having Quebec residents as shareholders or directors.
Okay.
But if you were doing federal,
You
then
need at
you
least
would have
25%.
25%.
And what happens typically is the foreign studios, they come here, and either they trust you and you're an administrator or you're a shareholder, that happens a lot, or they want to control the corporation. So, and they come in, they do the production, they administer the payments, the contracts, everything, and they want to own that corporation, so that allows you.
How does that interfere with CAFCO Canadian content?
Doesn't matter. CAFCO, as long as you're incorporated in Canada, you're fine. But even if you're content, you can be incorporated in Quebec and be eligible for content. And then there's the parent company. So let's say, in the grand scheme of things, you have your loan-out corporation. Eventually, you're going to create your parent company where you'll have development. You'll try to access development funds. You might have a few IPs from your productions. You're going to solicit sales, tractions for your projects. And once your project's created, the SPV will hire your loan out, and then you'll be able to claim 100% of tax credits on your loan out, and be tax efficient. Instead of paying yourself as an individual, there is a fiscal incentive just pay yourself through your corporation. Because in your corporation, whether you make a $1 or $1 million, you're taxed at 26.5%. And as you know, as an individual, the more you earn, the more you pay taxes. The threshold being 105. The limit, not the limit, but the point where it's more fiscally, the incentive is greater is at 100,000, where it's better to just pay yourself through your corporation. Okay, so financial statements are separated into two statements. There's the balance sheet and there's the income statement. In the balance sheet, you'll have your assets. So anything that is like your cash, anything that you hope you're going to receive, like your tax credits, your grants. There's also going to be all the projects that you're working on that are capitalized, projects that are not yet ready to be exploited. Remember, when you're doing a film, it's like you're building an asset. You're building something that you're going to develop. It's like you're building a building or a property that you're going to exploit down the line. As whenever you're incurring expenses for your production, it's all what we call capitalized. Capitalized meaning it's all part of your assets. It's not part of your income statement, meaning not part of your revenues and expenses until it's ready to be delivered. Then your liabilities, that's where you'll find your, I'll go through all the breakdown of the liabilities, but it's basically what you own. And then the income statement is your revenues and your matching cost. In accounting, there's a principle called the matching principle. So it doesn't mean that if you receive a $20,000 grant, that you're taxed the year that you receive the grant. You only put that amount of money in revenues whenever you incur money. So that it's a dollar for dollar. So if this fiscal year you've paid $10,000 of costs, you only declare $10,000 of revenues. The rest you put in liabilities. You put in deferred revenues until you use that money to spend it on costs. So that makes so you won't have a year where you get your grants, you get $20,000 in revenues, you pay tax, and then the following year you have $20,000 in deficit, and then you carry back your loss to the last year. It doesn't make sense.
So if anyone wants to double click on this is like a great example of like when I incorporated, I received the art grant in 2023. I gave it to my company in 2023 as well, and my company invoiced for it in exchange for the production services. Production was carried out in 2023, thereby all the expenses, but we deferred it, and now either we're going to declare it in 2024 or potentially 2025 so that it aligns with the licensing. So I won't get too deep into, and I'm not 100, we have to actually talk about how to lay the dominoes out, but that's one of the benefits of the corporation that you can't do with the person. Like, and so that's where like you get an arts grant. That is your income. Like if you get an arts grant, correct me if I'm wrong, if you get an art grant on like December 31st, 2023, you have to, as an individual, you would theoretically have to declare that as revenue as an individual in 2023. Which could compromise the amount of money you actually have to then spend on the film if you paid income tax on that in 2024 when you actually produce it. And I think that's where a lot of artists have gotten screwed. Correct me if I say anything wrong, but the point is that's another benefit of the corporation, is you can defer between calendar years to align with when your assets and liabilities match.
It's cleaner in a corporation, definitely, but nothing stops you from doing it as an individual. You could still defer. The thing is with the grants is that, let's say the Canadian Arts Council, they'll issue a T5. Remember, was it a T5 or a T4A?
Yeah,
they issue T4A, and they issue a T4A. That means they send to the government a proof that you've collected money. And so whenever the government sees this, it's automatically, exactly like you said, they say that's revenue, you're taxed. But in reality, you're only taxed whenever you're gonna incur the costs. So what we do, what we recommend, especially if you have a corporation where you'll claim tax credits and you'll manage your production through that corporation, is that we transfer the grant. We'll transfer the grant to the corporation. How do you do that? So as an individual, you get your T4A, you're stuck with that revenue in your business income. So your T4A, there's two ways you can register it: in your personal income tax, in the T4A section, or in your business income section. In the business income section, it will say, okay, is this revenue based on invoicing or is it based on a T4A? You select T4A, and then you have a matching expense in order for you not to be taxed as an individual. Why do we do that? We invoice ourselves from the corporation to ourselves as individuals, so we create that expense on the individual tax return, and so you transfer that revenue to the corporation where you'll defer it to whenever you'll incur the costs. Is that clear? I know it's a difficult notion, and we face it a lot, but yeah.
It's like $60,000 from Canada Council in the personal bank account, and then it's invoiced from Intersectional Films for $60,000, and then $60,000 disappears from the personal bank account. So Gavin, the individual, made nothing, like on paper.
He made 60. He had 60 of expenses. There is a transfer of money.
Okay.
But just clean, as an individual, 60 revenue, 60 expenses to the company I own.
Okay.
In your statement of business income, in your personal income tax.
So the statement is zero.
Yeah.
So you pay tax on zero.
Yeah.
So you're still
In
poor.
that calendar year.
But because the money is going elsewhere, and then you get paid by the company for your services.
It's not even in quotes, yeah, then the corporation I own hires me, Gavin Seal, as a director, as my own legal entity, as an individual, and then pays me the director fee.
So like, let's say that's 10, so then, you'd have the invoice for 10, and then the rest of it is
Yeah. But a traditional, go ahead.
This is why he's here, because this is actually the most Enjo system coming in later, where it's like, this, I know, it's a mind to think about you giving money to the company and you own the company and then you're paying yourself, but it's not you, it's your company, and sometimes it's you as a director, and sometimes it's you as a screenwriter, but then you're selling IP, and then it's a mindfuck, but you're gonna get through it.
So okay, just to add on to that, so then once the money is transferred, like you said, you pay yourself, and then if you hired any consultants or whatever, they just get, the company pays them as well.
Correct.
And then expenses are paid through, as you put in the budget, but it's the company that's actually doing all the spending and everything,
Yeah.
and then claim everything at the end of the year, that this company hired Gavin, hired these people, did this, that, and so forth.
Yeah.
Okay. All right.
Yeah, but you see, like a typical accountant, so that's like the typical situation.
Yeah.
Someone calls me in 2025, and they received a letter from the CRA, from the Canadian Revenue Agency, saying, hey, back in 2023, we see that you've received a T4A for $50,000. You owe money on that. But
Right.
you said, no, I transferred it to my company. And then there's no proof of that. So then we have to go back in time, create an invoice. And then a typical accountant, what they'll do is, let's say you deal with a typical accountant, they'll say, okay, you transferred that revenue, you invoiced yourself. So in that same year, they're gonna recognize that grant revenue and you're gonna be taxing your corporation. That's not the case. You only recognize that revenue when you spend. So there's a matching principle. That's the matching principle.
In that example, if you got audited, would there ever be a question of like, what services exactly did Intersectional Films render to Gavin Seal?
100%, 100%. Yeah.
Well, but then according
So
to
what would he say? Like, what
Okay,
did they do for him?
Global rule is, I'll say, invoice management fees. You'll invoice management fees. If you have specific costs that you could put in, like production servicing.
Production
director.
services, I think, is what.
Production services is what we have decided.
Yeah.
Yeah.
Okay, so it's not just like, it's a paper trail to transfer the money, you have to kind of have a story.
It is,
of why
it
makes
is,
sense.
but sometimes you fall on what we call at the office a rogue auditor. So that,
What?
that has like, you know, that want to destroy your life. So it happens. You hit them sometimes. So and so that's why it's better to have some substance. You know,
Okay, gotcha.
But especially it's for a project that you're probably going to be involved in. So try to put the invoice in relation to that.
Yeah,
Gotcha.
I mean, usually when you apply for a grant, you specify what the role is and all
Yeah.
the details. So you would just take that information and say, okay, these are the roles
Yeah.
and these are the duties,
Yeah.
right?
Yeah.
Okay.
I think I also included a screenshot of my personal and corporate bank account. When the CRA asked me for a matching letter,
Yeah.
I wrote the letter with a very brief explanation. It was like one paragraph.
It was
I ran
excellent.
it by Michelle,
Yeah.
so I had the copy, and then I included the invoice, and then a screenshot from my corporate bank account receiving the funds and my personal account proving that it left my personal account.
Yeah. And
Pretty simple, actually, but
yeah.
terrifying. I think actually in your email you were like, first of all, Gavin, don't worry, you haven't done anything wrong. Here's what we're gonna do. Here's what you need to do. And he's great with that, where it's like, it's a very emotional
Yeah,
experience.
it is.
It's very scary.
For sure.
Okay, yeah. The other thing with that is that you're doing invoicing. So typically you have to charge taxes, especially if it's over $30,000. If your grant is less than $30,000, you're fine. But then you have your GST QST issue. So if you're not registered personally, that becomes an issue. Whenever you have two corporations that own one another, like let's say a parent company and an SPV, where the parent company owns 100% of the SPV, there is a way to exempt any sales taxes between for the transactions in between the companies. But whenever it's between the individual and its own corporation, even though that individual owns 100% of the shares, there's no exemption. So you have to charge tax in that transaction, which is ridiculous. But because you're gonna pay it on one side, you're gonna remit, and then you're gonna claim it on the other to the government. So you're just loaning money to the government.
Oh God.
Right? Yeah.
Yeah.
Yeah. There's no exemption, and sometimes, like, depending on your level of risk, you just won't charge it or you won't do the transaction. You just do it for the amount of the grant. And that's it. If you're okay with that.
Now, I will say, and also tell me if I need to cut this from the recording, but
Cut everything from that. This stays accurate.
because the other value of transferring the 60K to the corporation was now the corporation has the 60K. So I, as an artist, was able to wrap up my reporting and say this is what happened, the 60K is with the corporation. And then when I produced the film, that 60K was used for the corporation, and I dealt with the sales tax through the corporation. But I think something that some artists do that ends up also putting them at risk is essentially they're like, oh, I have 60K to spend, and they don't remember to allocate that if they actually spend that whole 60K to contractors who are charging sales tax, then they'll actually get invoices equivalent to 70K, roughly, right? Because those 60,000 in labor is going to have the 15% on top. So that, I think, is often under forecasted with artists.
Absolutely.
So there's the income tax thing you got to watch out for, and then there's also not being aware of how sales tax will
Exactly.
happen.
Okay, so to go back to the balance sheet, on the asset side, these are the typical accounts that you'll see. So cash, this is the cash that you have. Accounts receivable, and anything that you're receivable. It could be sales taxes, it could be tax credit receivables. Like we said, your projects are either capitalized as projects in development or finished projects. Why would a finished project wouldn't be recognized if it's ready for delivery? Maybe it hasn't been delivered. Maybe you haven't found a distributor or a broadcaster to deliver it to. So it's just stuck in your books until you get revenues. Because just from nowadays, maybe it might only be costs. Or maybe you have 100,000 in costs and only 50,000 in revenues. So you can only declare 50,000 of cost and revenues. The rest is stuck in finished project. And let's say on a project you've had more expenses than revenues, and so you're stuck with that asset that might just never get sold. You can amortize it at 30% every year against any other revenue. So in your balance sheet, you have project in development 1, project in development 2, or you can have their names. And then ideally, in project 1 in development, you double click on it, or you have an auxiliary document where you have all your charter of costs, right? You have either your cost report and your detailed budget, and you see where you're at in your production. Comes the day that you finish your project. So your project is no longer in development, it's a finished project. It's still part of your assets. It's a finished product that's ready to be exploited. Normally, you could put it in your expenses if you have any revenues. If you finish your project, it costs you $100,000. We're able to sell to CBC for $50,000. So, sorry, $5,000. so you put $5,000 in your revenues, and you can only expense $5,000 of your cost. So it costs you $100,000 in your finished project. In your balance sheet, you have $100,000. Now you can deduct only $5,000 because you only had revenues of $5,000. Okay. 5,000 is the only thing you're gonna get. With time, with years, you went to many festivals, you couldn't sell your film, you're just stuck with that asset. You're getting other revenues, maybe for other projects. You could still amortize meaning you could expense a portion of the project, you're limited at 30%. That's the rule fiscally. That you could put it in your expense, your finished project, you amortize it, you use 30%, you decrease your finished project by 30% every year, and that goes into your expenses. So it offsets some of your revenue, you pay less taxes.
So you
Yeah, it's a lot. Sorry.
If you
No,
make,
it's good. It's really good. Yeah.
If
It's
you,
good. It means your project you weren't able to sell it, but because ultimately what you want is that your revenues are going to match your costs. You're going to declare both when it's ready to be delivered. You deliver it, boom, that's it, finished. And your production company doesn't pay taxes because your revenues match your costs. You've paid yourself to your little corporation. With time, maybe there's a second window. Your licensing deals are finished. You're able to licensing to another broadcaster, another distributor. But by that time, the IP is in the parent company, and it's just the parent company that's collecting the revenues. Because your film ultimately it has a huge lifetime. It's not because you're not making money now that you won't make money in the future.
Yeah.
so you can amortize. So let's say you make in let's say 2022, which is 3 years ago, right? 4 years ago, or 2021. Let's say you make a project in 2021, and that doesn't sell. Now, you amortize it 30% each year, and then by next year, you basically that goes away, right? So you're like, oh yeah, like we had a bum project, it goes away, and then let's say 4 years later, oh suddenly it's on this platform and it's making money.
Yeah.
Then you have.
Then you'll have a revenue, but you won't have any expenses. So you're going to be taxed at 100% on that revenue, which is fine.
But let's say it's $100,000 is a nice number. You just made $100,000 disappear, and then let's say you have a wonderful CBC license of 5.
Yeah.
You get taxed 100% on 5.
Yeah.
Okay.
That's what I think
Which is
too.
normal.
So that's why a project that doesn't go anywhere is considered an asset, right? Like it's an asset until.
Oh yeah, exactly.
Okay.
Yeah. And you can only amortize to the extent that you have revenues. You can't create a loss with your amortization.
Okay.
And fiscally, it wouldn't make sense. Just to have an expense. You're better off having a revenue that's not relating to that project, having your amortized at 30%, so you pay less taxes on the net.
Can you amortize over a longer time horizon?
No. Unless you only have little revenues every year, you're limited. The amortization is limited to your revenues.
Right.
If it's higher, then the limit is 30%.
So you could do that though, like if we're talking about, I'm getting confused with the numbers, but let's say $100.
Yeah.
But you only have $20 of revenue per year. Can you amortize over 5 years?
Correct. You have to.
Yeah. You don't lose the other $10.
No.
Because it was on a 3-year
Correct.
amortization
Correct.
period.
Liabilities, again, this is what you owe. Maybe you have a bank overdraft, accounts payable. Accounts payable could be sales taxes payable. Deferred revenues is any funding sources that you've received that you're not booking as revenues right away. You're gonna wait until you deliver the film, you're gonna put your costs in, and your liability is gonna go away. The deferred revenues are gonna go away. They're gonna be converted into revenues in your income statement. Accrued liabilities is a liability that, let's say that you've ordered something, you asked someone to work on a project, you haven't received an invoice, but you know it's coming. So you want to book that cost, and you know that you're going to owe that money, so you put it in liabilities. I put deferrals here. Deferrals are not expenses. It's just it's a side agreement with someone that says, I agree to defer my fees to whenever you have enough funding to pay me. So whenever you have enough funding to pay me, I'll invoice. At that time, you can create an accounts payable, and you can pay that person. So deferrals are not part of your income financial statements. Okay, advances. This might be your revenues that some deals are negotiated based on milestones. Maybe you get a deal with a distributor, broadcaster, or copyright owner that will pay you advances so that you can start production already. So that's something that you'll only declare in revenues again once you've delivered the film. You have your loans here that could be used to interim finance tax credits. As you know, most of the financing sources, you receive them only once you deliver the film. If you're a good negotiator, maybe you could get some in advance, hopefully. But if not, you have to turn to a bank, write a comfort letter that says in the comfort letters that is usually prepared by an accountant, like we do a lot. We do a tax credit estimation, we do a risk assessment, we look at all the other sources of funding, and based on when they're going to be paid, we ask the bank, okay, please lend us that money on that date, and then we build a cash flow, and we get into an agreement with them that they'll fund the production, through the production. And the reason why we do a cash flow is you don't want all the money at the beginning from the bank, because that's when the interests are going to start kicking in. So you want to defer the interim financing as far as you can. Okay, share capital. This is your common shares. You'll typically see $100 of your shares. If you get an investor, so that's in the case of an SPV, I always recommend having investors in an SPV, not in your parent company. Why give them ownership of your IP if they didn't contribute anything? If they're contributing on your slate, okay, I understand. But if it's only for a specific project, have them invest in your SPV. What does it mean invest in an SPV? That means that the SPV will issue them shares. We usually recommend preferred shares, where the shares are only redeemable by the production company. So as a production company, you don't want your investor to pull out in the middle of your production. You want to decide whenever you're going to pay them back. And it's usually based on a recoupment schedule. And so they're part of your share capital. So in your share capital, you have your common shares, and you'll have your preferred shares that you issue to your other investors. Income statement. So these are the typical sources, the revenues that you'll find. So the sales, distributor, broadcaster. Whenever the production is ready to be delivered, tax credits are also taxable. Grants, public funding, and then the expenses, your production costs, commissions, marketing, taxes. Okay, if you do not hold the IP, what does that mean? Let's say you're doing production services. You're doing production services. That means you're getting hired by the person that has the copyright. If they own the copyright, they are the one capitalizing the costs and only recognizing them when they're going to export the production. You're just being hired. So you're invoicing, you're getting revenues, and there's no capitalizing. It's not your project. You're not building your own property. You're just getting hired to render services. So you're invoicing, and it's directly in revenues. So whenever you're doing production services, there's no amortization, there's no asset. It's only you're invoicing for your services. You put them directly in your revenues.
Okay, so it's just in, out.
Correct.
We did this is the invoice, that's the revenue, simple.
Yeah.
And then, but if you own the IP, if you're capitalizing it, you're the one that, you hold that IP, it's like your baby, you're stuck with it, you gotta make sure that it's properly fed.
Correct.
Okay.
And production services, you can also defer a portion. Maybe the milestones that you've invoiced for are not rendered yet, and so the deliverables are not delivered. You could defer a portion that might be, an incentive tax-wise.
Sometimes people tell us to create a different company for development outside of your parent company. Is that good idea or?
Wow, that's the point.
I don't-
No, but honestly, I don't know. In a parent company, you're gonna source that funding, the development funding.
Yeah.
Hopefully, you know, you have many projects in development. Whenever something is greenlit, you just transfer it to the SPV. Try to keep things as simple as possible.
Yeah, I separate all my projects by different things. So.
You
We
can,
know.
you can have two projects or 3 projects moved into that, or
Yeah.
should you do, cause it would be too much to do one for each, right? You just have that second one and you can move the projects there when you have some
Oh, and
funding
the
coming in.
SPV?
Yes,
Yeah, you could recycle them. You could recycle them.
cause you don't just open, close in every
It depends
project,
because
right?
let's say you have investors, you have stuff like that. Sometimes productions get messy,
Okay.
and you're just better off closing it.
Yeah.
Just put it to.
Okay, and then open another one when your next project comes along and your next funding,
Yeah,
yeah?
yeah. It's a
Okay.
lot. If not, like the thing is, some production companies they accumulate SPVs, and then they have 10, and then
That's
then
what
at one point they knock on our door. They're like, okay, get rid of all of them. Okay. But it's better off doing it. But you can recycle them. I encourage you to recycle them. If you
Okay.
have another project going in, why not?
Okay,
It's
you
already
finish
there.
your work, you transfer that back to your other company, then start your next one.
Yeah.
That's okay.
Yeah, and you could even have more than one
Yeah.
in that company. Let's say you're doing a short film, you're
Yeah.
doing a web series. You know it's going to be quick, and
Yep.
the only thing is that you're stuck with that year end. Meaning,
Yeah.
whenever you're going to claim your tax credits, I try to optimize. Whenever you open a corporation, you have 365 days to decide what your year end is going to be. So if you do it today on May 30th, you could elect tomorrow, but I asked the producers a question. I say, when are you going to incur substantially all of your costs? So if you tell me, okay, it's at the December 31st, I'm sure I'll be done. We'll be able to claim tax credits on substantially all of the costs. So the first year end is going to be from May to December. Okay, so it's going to be a shortened year, and then following years are going to be from January to December. Now you have other projects going in. So if you have another production that you know you're going to be done in June, then you're stuck with that year end, and you have to wait 6 months to claim your tax credits. Sometimes your tax credits are financed. Maybe you finance them. You want to see them back. You have people to pay.
A question pertaining to that. So say you have this idea for an IP. First, it goes into a format of a film, and then you're like, oh, you know what? We can make a book out of this too. Boom, I want to make a book as well. So you would wait until the end of the fiscal, and then start on the book, and then
No, not necessarily.
you can still all do it
Yeah.
with the same IP all within that
Yeah.
year. Okay. Okay.
What would the book entail?
It's just basically
Paying writers. Again, you have to be careful on what are the activities of the company.
Okay.
You don't want to jeopardize your production status and become like, let's say, a publishing house or something else.
Okay.
But if you're only incurring expenses for the development of a book, let's say,
Yeah.
I wouldn't mind.
Okay.
I wouldn't mind. Ultimately, you're going to bring back the IP to the parent company, and then you're going to develop a book idea or something
Out
in
of
that
it,
parent
yeah.
company. But it doesn't stop you to use the SPV for the time being,
Okay.
especially if it owns the rights.
Yeah.
Yeah.
Another question, once your project is finished in an SPV, is there a rule of thumb of how long do we need to keep it open for a certain amount of time after? No, okay, we can just,
No, usually you receive your tax credits,
yeah, and then you can,
you pay back your investors, and then we close it.
okay, cool.
I'm gonna go through it, but I can explain it now. So this I just mentioned, the revenue collection, and then whenever you get to the dissolution, okay, you wanna close your SPV. So let's say you're gonna take the same example. Your year end is December 31st. We're in May. You tell me, I wanna dissolve that company, I don't wanna hear anything about it anymore. We have to apply for a dissolution certificate. So we apply it for it today in May, and it usually comes very quick. Like if you have your Click Secure Express number, we could do it. It could take like a week or two. We get a certificate of dissolution that has a date on it. It has, as of that date, your corporation is dissolved, and it's the same date that you receive the certificate. So we might receive it on June 15th. On that date, you have to do your final tax return for that corporation. That means you don't have to do your December year end. Your next year end is really June 15th. Okay, if you're calling me in January, you're telling me I want to dissolve that company, then I have to do the December year end and then go through the same cycle. Whenever I get the certificate, we do another tax return. there's resolution tied to it, and there's a resolution saying that all the IP goes back to the corporation when you close the bank account. You make sure that the distributors know that the bank account changed, because they'll keep your money. And, yeah.
Also, just to share personal, I had been given advice, not from Michelle, to align my year end initially with the broadcaster cycle. It's a common practice for some people. Good example of, I think that person was further along in their journey, so they had more SPVs, so it was relevant to them. For me, having just incorporated my first production company, it actually ended up complicating things, and so Michelle taught me how to send a letter to the government because it was within the first 90 days or whatever it was. And I just sent a letter and I said, hey, I made a mistake. I'd like to change my year end to a calendar year. So, and then it was fine. So again, you're gonna make mistakes, you're gonna get advice that might not be contextually relevant. It's gonna be painful, you're gonna learn a lot, which is gonna allow you to get further ahead of the pack that resists learning through doing.
Yeah.
And then
Yeah.
you're gonna be stronger for it.
True.
And usually it takes 6 weeks to get an answer from a request of year-end change. And I know recently they denied a lot of them. Because us, we try to align the SPV with the parent company. Or what I recommend is, if you have a loan out, do it on December 31st or close to December 31st, because as individuals, our fiscal year end is from January to December.
Yeah.
So if you have like fiscal planning, like in November, December, like, okay, I would like to pay myself maybe a salary or a dividend, how is it, fiscally more effective?
Mine is to be in line with my not-for-profit, which Sodek also told me to open, so I could apply for my film festival.
Okay.
That didn't work out very well with them, but now I have these two, for-profit and not-for-profit. And then when I did all this myself, because I wasn't in a position to pay for services for someone else to do it, I did the incorporation with the help of my dad, who has an incorporation as well. So we did both of it, and then I realized that I'm going to be doing income tax for the federal and then the provincial, and then the federal and the provincial.
Right.
4 income taxes, which is on top of my registered, on top of my personal income
It's a
tax.
lot.
It's crazy. So when I spoke with someone at the CRA, they told me, why don't you align both, and then you have provincially and federally, you just make everything like conform, So then I realized, the first income tax already sent it out, and then I did it for the other 3, the 2 provincial, 1 federal, and that's when I sent out the request at the federal level to then just get that first one in line with the others. And I explained that's the reason why I'm doing it, and they told me at the CRA it's almost sure it'll be a yes, but you do have to present it in writing.
Correct.
You send it, and then they will get back to you. So it's more than
Correct.
6 weeks now. It's,
I
I think,
think
8
Yeah.
weeks.
My advice for you is stop trusting the government to tell you how to
Well,
do
I
things.
learned that today
And
when
start-
we just spoke a little while earlier, that Sodek was giving me the wrong, I think, direction, and
Start
I,
hiring experts
Yeah.
in their fields.
And,
Yes.
just so you know, SODEC, they have
It'll
a
save you
program.
money in the long run.
Yes.
Yeah, and SODEC has a program where they'll cover my fees.
Oh, they do?
What? Excuse
Yeah,
me?
if-
What are you telling us now?
If it's not related to I just spoke to them a few weeks ago. If it's not related to a project, if it's relating to your corporation.
Yes.
That's right.
And
What is it called, the program?
do you know the name of the program?
No, but I remember reading about it.
Okay, so I'm gonna go through just the typical financing structures that we see. How do we book them? I'm sure you know them all. There's not one that's simple. It's all you obviously know. The equity investments, we've been through it. They're rare. They exist, but the key is that you give them preferred shares that are redeemable by the production company. That's the main key. Distributor versus broadcaster, you know the difference, I'm sure. Distributor, they recoup on their advance. They get a commission. Typically, I see 30%. They have their marketing fees. They can charge interest. It's very difficult to get your money back whenever they make a sale. So make sure that you find a distributor that works for you and that you get along with. Recently, whenever I negotiate with the distributors, sometimes they say, okay, my marketing expenses are $100,000. I tell them, okay, we're gonna cap it at 5% of any sales that you make. Because if not, the thing is they're gonna make sales, they're gonna pay back themselves and you'll never see your money again. You understand? Okay, and the distributors, them, they recoup, they're the first ones to recoup, meaning if there's any sales, they pay themselves first their commission, their expenses, their advance, and then from there, so let's say their commission is 30%, the rest of the 70 or 60% that's left is going through the waterfall. Broadcaster, on the other end, they give you a license. So they pay a license fee, meaning they will have the right to broadcast your content on their platform for a certain period of time and for a specific amount of money. They don't do any recoupment. So if ever you're approaching an investor and you're showing them your financing structure, he's way more interested in a production that has broadcasters instead of distributors, because he knows that any future sales that you'll be making is going through his pockets, and he's going to make a deal for that. National tax incentives in the recoupment schedules, the tax credits count as producer equity, so that increases your recoupment. These are also recognized as revenues whenever you're going to get them. I don't know if you're aware of tax credits. As you know, as part of Canada, we have the federal government, and we have different provinces. Each jurisdiction has their own tax credit incentive. As long as you hire people from that province, the province will pay a portion of their salaries, and the federal government will pay as well. Content, the Canadian people can work anywhere in the world. Quebecers, the same thing. The big thing with the Quebec incentive is that you can hire Quebec non-residents, so you can hire a star and still claim tax credit on their amounts, whether they render their services here or not. Production services is the same thing, but they don't allow tax credits on the key positions. So let's say an AD comes to Montreal to shoot on your film, you can still, an American AD, you can still claim tax credit on their fees as long as they render their services here, and they invoice you as individuals. So that's a nice incentive for Quebec. Gap financing is, there's these gap financiers that exist that they're gonna look at your financing structure and see the territories that are sold. So let's say you only sold Canada, they'll say, okay, I'll give you an advance for the rest of the world. So you're giving them the right to export your productions through the world. But typically they come in at the end, they'll represent between 5 and 15% of your financing structure. The producer deferrals are a big thing. Nowadays, I know the environment is very difficult. I see a lot of financing structures that have high producer deferrals or reinvestments. The reason why we do reinvestments is that we can trigger tax credits. So the production company will pay you as a producer, and then you reinvest a portion. So at least you can trigger the tax credit. The other option is that you defer your fees. So what I was saying is that I see a lot of productions now that the producers are really enthusiastic and they want to produce, but the thing is, like, it's not a good business deal. You have to be careful on how much you're deferring, and to the extent you don't want to work for free.
So, I think I've had this conversation with some people around with the tax credits. A producer deferral, where the producer, what happens is you get paid, the production company pays you, the money goes into your account, and then as a producer, you reinvest that money back in the production?
That's not a deferral, that's a producer investment.
Oh, okay.
So that's the key difference between a deferral and an investment. Deferral means I'll charge in the future. There's no exchange of money for now.
Okay.
Unless there's additional financing, probably means I'll never get paid.
So if you, to maximize tax credit, you want to have the production company pay the producer, and then you can claim that money, and then the producer can reinvest that money back in the company.
Correct. And that reinvestment, when we looked at the share capital section, because you're the producer, it could be common shares, it could be preferred shares, it doesn't really matter. The preferred shares is if it's someone that's not, if it's not the shareholder or the producer, someone that you want to keep at the arm's length.
Okay.
But you yourself, whenever you reinvest, it's in form of a
producer,
common share.
shareholder investment,
Yeah.
shareholder equity investment.
Yeah.
Something like that.
Correct.
And what does that look like on the producer's income tax return as an individual?
Yeah, that's very important.
Question.
So whenever the production company pays you, you're taxed on it personally. And then you're reinvesting that money. That means you're not even left with that money. So you're taxed on money, and you don't even have, you can't benefit from it. I mean, you can benefit in the sense that you can pay costs in your production, but you're taxed on it. So how we structure for that is that you only reinvest the portion that is net of taxes, right? So
And I think this is an example of a commonly misrepresented or just underlearned, whatever the term is,
Yeah,
because
good
I think in
point.
Quebec I hear this a lot, where it's like, oh, we'll give you the 60%, you have 60,000, you put the 60,000 back in. And you're like, okay, yeah, this is how it's done.
And then you get
It's
hit
like-
by tax, yeah.
And then you get hit with income tax. So,
Mhm.
yeah.
right?
And then
Even
that,
technicians have had to go through that, like.
that
just
technicians will be asked to
crew.
reinvest
Yeah.
because the producer doesn't know.
And just so you know, in Quebec, for tax credit purposes, you can have reinvestment from people working on the film, except for the producer. In Ontario, they allow it, but it's creating artificial tax credits, which is not ethically right. But so that's why Quebec they don't allow it at all. Ontario, they are. Public film grants, the same thing. You defer it whenever you receive it. You're gonna put it in your revenues. I'm just gonna put money for the parking. Sorry. I just want to touch on brand, brand partnering. I've been to countries that they're not lucky like us, where we have a lot of public funding like tax credits or anything, like Brazil, for example. They rely a lot on brand product placement. For us, it's something that we rarely see. I see it sometimes, but I rarely see it. It's also something to think about when you want to source financing. Obviously, it grinds your tax credits, but it's still good money to have. Okay. Yeah.
So my question is, I have a corporation now, but the main activity is marketing or service, right? Not the IP. That could be the parent company, right? For the SPV, even if film is not its main, or IP is not the main.
Yeah.
Yeah, that'd be fine.
Yeah, it's just look at it depends on where you're gonna apply. Maybe like telefilm, they'll ask you to have a production company. But they're not gonna go deep in your. I wouldn't mind.
So and then I would do the SPV for the project, right?
Right.
Now, if I have accounting in place for the corporation because it's just more like a regular business, they're a general purpose accountant, and when I ask them about tax credits, they're like, you better consult with an expert. Could I work with a firm such as yours to consult for all the film-related stuff and handle the SPV and leave them in place, or is that a recipe of too many cooks in the kitchen, and it's got to kind of be one or the other?
There we go.
I
I don't know. I like. For me, like for sure, it's easier having my hands on everything, so it's easier. But if we have good communications with your other accountant, I don't really mind.
I've mentioned Alex Harmozy a number of times, this entrepreneur thought leader guy, and this is one of the main things that holds entrepreneurs back is knowing when they need to let someone go to grow the company and finding other partners, etc. So I'm not advocating that you switch to Michelle. I'm very happy with the services, but
I'm on a small budget web series. So if I were to bring somebody from the States to work on a production here, but the rest of the team is Canadian, from Toronto and Montreal, how would I go about doing that? Is that doable?
Of course, it's doable. And
does it complicate things more for me, or does he make money here and take it back and then has to declare it in his income tax? Because I'd be
for that.
Yeah, I'm just wondering.
He's gonna pay his taxes there, just because of the treaty that we have with
and
the US.
does it give me any additional work for me when
Yes.
I'm doing
Yes.
mine?
There is a waiver that you have to apply for.
Yeah.
So that you can register your your company is here, so
Yeah.
You're gonna have to apply for a waiver. Anybody that works behind the camera
Yeah.
is exempt from withholding tax. So any non-resident that comes
Okay.
and work on a production,
Yeah.
you have to apply to a waiver at least 30 days before the start of principal
I have to
photography.
apply, not him. Me.
The employer, correct.
Okay.
Because it's your responsibility as an employer to withhold the
Okay.
deductions at source for all the employees, including the non-residents.
Okay.
But with
So-
that waiver, you
I'm
can
wondering, yeah,
usually
that's
it's
what I want to know.
usually it's the production accountant that does it for the person.
Okay.
It also happens that the artists themselves reach out and we apply for the waivers.
Yeah.
So anybody behind the camera can get a waiver where they won't get any withholding tax on their pay, so they'll get 100% of their pay.
Okay.
For anybody that's an actor,
Mhm.
the federal withholding tax of 23% is mandatory,
Mhm.
and there's a 9% Quebec tax on top of that that you can get a waiver for if you're an actor.
Okay.
The 23%, we can, let's say that person, they incurred traveling costs, lodging costs to generate that revenue. They could do a tax return and say, okay, this is the income that I got paid on this production. These are all my expenses, and I should only be taxed on the net instead of the whole amount.
Oh,
And so they have to do a Canadian tax return for that,
okay.
and they'll get reimbursed the difference.
Perfect. Okay, thanks.
It's a lot of work.
So on that note,
For like
I'd like to
it's
end on a
work.
quote
Yeah.
from slavery abolitionist
really
Frederick
good work.
Douglass, who said, "Knowledge is the pathway from slavery to freedom." Hopefully this knowledge will help you gain a little more agency in your journey as entrepreneurs.
Thank you, everyone.
Thank you.
Thank you.